Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Joe Saluzzi on the line. He's a partner and co-founder of Themis Trading. Joe, how you doing this morning?
I'm doing great, Joe. I'm doing great. How you guys doing?
We're doing good. We're just kicking around here, watching the S&P futures hit all-time highs here again. So the same story, same party continues. I got my all-time high hat on here, Joel. What's your thoughts here? First, we're going to get into the market structure in a second, but this market just continues to grind north here. What are you feeling like from your trading desk there? Are people getting long? Are we still running this bull here for the next year, or what are your thoughts here on the overall market?
We see mixed flow. 'Cause, we're institutional agency guys, so we're seeing all different types of flows. So I don't think there's really a good way to gauge it. Like maybe more of for a retail broker can kind of tell if there's lots of interest coming in. But we're seeing mixed flow. There's certainly no panics when the sell-offs happen, and no euphoria when the stock's going up. So it's actually a very moderate pace, which I guess is good. But I'm with you there. It's kind of amazing how we're at these highs. In particular, look at Europe. Europe's had highs, and I thought things were supposed to be pretty bad on Europe. But we know the elixir of magical central banking actually fixes all that. So I guess that's what's going on.
That's what seems to keep happening. And then you got the market structure. I know you guys are very focused on this over there at Themis Trading. And interesting, the NASDAQ's doing some experimental pricing there back just earlier this month. They're actually reducing the access fee, which is the take fee, so that we're talking about there, from 30 cents down to only 5/100ths on 14 different stocks. One of those stocks there is Bank America. Joe, you were tweeting out about that yesterday. How's that working for them so far?
It's actually really interesting. We thought the initial most people in the industry thought that NASDAQ doing this unilaterally, in other words, by themselves with the 11 other, 10 other stock exchanges not complying with them, would actually hurt their market share. Most people were thinking, because if you don't offer a rebate, well, then why are people going to post liquidity if you don't offer a large enough rebate? But it turns out that, in fact, they have 14 stocks in the experimental program, and overall, in the first week, they only lost about 1% market share overall, which I thought was pretty good. And then, in particular, some of the names, like Bank of America, market share actually went up. And I think what's going on there is, there's different types of traders, right? There are certainly high frequency traders who are trading for, whether it's rebates or whatever they're doing, but there are guys who are market makers, right? And they're crossing the spread, and they're looking to they don't want to cross the spread. They want to trade on the bid and trade on the offering. So, they're posting where they think they're getting the most activity, and apparently there's a lot of stuff going on in Bank of America right now, and it's not hurting, which is actually a good thing, because the industry now needs to take a look at this maker-taker model, which has been on forever. We're offering rebates and paying access fees, and this program is the first step in what we think is actually could eventually become the elimination of maybe maker-taker altogether.
Do you think we should get rid of maker taker there, Joe? I know you guys are not been fans of it, and it does distort pricing. A great paper by Robert Botelho at University of now I can't talk, at the University of Notre Dame there last year was just showing how it can distort and how brokers sometimes only route orders out to where they're going to get paid the most. If we got rid of all that complexity of the maker taker model, wouldn't it make everything a lot more simple?
It would, and I think, like you just said, it takes a lot of the conflicts of interest out immediately. So a lot of the market structure problems that we talk about, whether it's order types or latency situations, the SIP versus direct feed, and so on, a lot of these things could potentially start to be solved if you got rid of the conflicts within the smart order routers that the brokers offer to their clients. In other words, if you place a bid and you want to buy 5,000 shares, where's that order going to go? Which exchange? Which one of those 11 stock exchanges or 40 dark pools? If you've got a flat fee structure in there's no incentive to go to one versus the other. You're going to go to the best market center, the one that offers the fastest, most quality, highest robustness. So to us, it makes a lot of sense, where get rid of the noise, and a good textbook example already is IEX. IEX has a flat make-take rate. Okay, they don't charge a different rate whether you make or take, and they've been very successful. They're already, less than a year, they're 1% market share, and they're not even lit yet. They're dark still. So you don't need, in our opinion, a difference in rebates and exchange fees, the access fees. Exchanges can still make their money, and exchanges should make money because they're providing a service. But this entire rebate game where someone gets more because they're offering retail orders or they're doing things like that doesn't need to be done. Now the other part of the argument is some guys are saying, okay, let's just lower the access fees. and that's where we are right now. That's like the first step. So, we're kind of going more aggressive, saying, no, get rid of rebates altogether. The in-between step, where a lot of the exchanges and even high-frequency firms are now lining up, is saying, okay, let's make an access fee of a nickel or 5 mils and a rebate of slightly less than that. It's at least a start. We're going in the right direction.
And is the idea to attract some retail flow? Because right now, most of your retail brokers don't route to the exchanges because of those access fees. Because if you have, just for example, a company, one of the retail brokers, and they're charging you $7 a trade, well, that's a flat rate. If they route a Bank of America order out to ARCA and there's 2,000 shares, well, they'd have to pay the 3,100s. They'd have to pay $15 on that order. They could actually lose. Well, actually, I didn't do my math very well. Let's say 5,000 shares of Bank of America. 30 cents and pay $15 on that order, they can actually lose money on that order. So that's why the retail brokers don't want to route to the exchanges, because of these access fees. Isn't that right?
Absolutely right, and that's why the pools of liquidity have been so segmented, where a lot of that retail flow never makes it to the lit exchange. It never makes it to the interact with other flow, whether it's hedge fund, mutual fund. It's out there being intercepted by these market makers when they choose to, and it will get exhausted eventually when you have days like the flash crash, and then no one wants to touch it. Right? It goes out to the lit exchanges, and we have problems. But there really is a problem when a retail broker. Let's take, for instance, there's a new retail broker out there offering free trades. Well, we know there's nothing for free out there. There has to be payment for order flow, and if you look deeply into the details, there's payment for order flow. When the order is getting sent, it's being intercepted by a market maker, and that's where they're making their money. So we understand that, but let's be real here. The cost of the trade is not $7 or $0. The cost of the trade is where does your flow go, and is it really doing what it's supposed to? So bottom line is, if you got rid of this noise and you got rid of the payment for order flow, we think you would have a much better price discovery process, a much more interactive pool of diverse liquidity participants all interacting together like a marketplace is supposed to be, as opposed to saying, I've got 5 different marketplaces, I'm going to choose when I want to intercept one. That's not the way you're supposed to do it.
Yeah, we call it toxicity of flow on the exchange, and the exchanges have toxic flow because they don't have all this other types of retail flow making it to the exchange. So as the flow becomes more toxic, market participants are less inclined to provide liquidity. The only ones really trading, it seems like, on the exchange are the high frequency traders. And you just wrote an interesting blog on your site there on Themis Trading on how institutional, you were asking, have modern markets really brought down your institutional trading costs? Because a lot of people say high frequency trading has actually brought down trading costs here over the course of the last decade. But on your blog there, you're kind of saying that it really hasn't come down.
The decline in transaction costs, or spreads, if you want to call them for that, happened with electronic trading and decimalization, and that happened in the early 2000s. Okay, and the rise of HFT on NYSE-listed stocks in particular started in 2007 with Reg NMS. Prior to 2007, they were still trading NASDAQ on NASDAQ stocks. There was high frequency going on for a long time, okay, so this is not new even to 2007. But the drop in transaction costs really happened with electronic trading, and we're big advocates of electronic trading. We cut our teeth over at Instinet back in the 90s, which was one of the original electronic brokers, so that's a good thing. When you add efficiency to a market and you add technology, it makes things easier for everybody. We want that, okay? And decimalization was a good thing as well, because hey, who trades in eighths, right? The eighths of the Spanish gold coins, it made no sense. But what you did was they shrunk it to a penny, and they said, okay, the tick will be a penny. Okay, the spread will be a penny, and that's where the problem started, because it allowed of more price points to intervene, more noise coming through, which is why now the tick program people are talking about, we call it, it's the tick size pilot. You may want to bring back some economics if you widen out the spread while still keeping in decimalization, but that's a whole other topic. But the bottom line is trading costs have come down, not necessarily due to high frequency trading, but due to electronic trading and decimalization.
And over the course of the last, say, 2005, 2006, by this chart that I'm looking at on your blog, they haven't really come down at all.
No, because they had already shrunk. That's right, because in early 2000, that's when the electronics and decimalization happened. That's when the big drop happened. So now, actually, you start, depending on how you measure your cost as well. If you're looking at just the spread, well, that's one thing. But, do you want to move 100,000 shares of a $30 stock as an institutional trader? Then you need to measure the cost a little bit differently. And those costs, some studies have said that they've gone up. So it's really, garbage in, garbage out, depending on how you're analyzing this stuff. But, bottom line is I don't think some of these, let's just say high-frequency trading advocates, lobbyists, whatever they are, running around saying that they're responsible for decreasing costs. That's not exactly accurate.
But you guys aren't totally against high frequency traders there, are you, Joe? You're just more against like some of the predatory stuff that happens out there, right?
That's right. Well, I mean, here's the problem. How do you even define what is high frequency trading?
Yeah,
Can
it's
anyone
true.
define it? You know, I was on a committee at the CFTC, and we were charged with defining it, and we had a fight basically for months to try to figure this thing out. You can't even define what it is. Is it latency? Is it quantity? Is it is it trading on multiple asset classes? So I don't even want to go as to there as to figure out what it is. We're against things that conflict the market. We're against things where routers are going to the wrong spot, where the exchanges are selling data feeds with robust information. They're selling high-speed wires to get you in there. Even the high-frequency traders, the ones that we can't define, are against a lot of the things that we're against. So it's kind of funny, actually. We line up almost probably, we've been looking at some of these topics lately. About 80% of the issues, we're lining up with them on the same side and saying, well, yeah, we're against that as well. Like market share, for instance. Should an exchange be able to show up in the quote if their market share is 1%? Should you have a lit quote? Should you have a protected quote under Reg NMS with a 1% market share? We don't think so. And the high-frequency traders don't think so. You know why? Because they don't want to connect to all these exchanges and pay the fees. That's their problem, is they have to connect to everyone because they can't miss anything. So there's a lot of inefficiencies in the market, or let's just say conflicts that have been set up over the years for certain parties to continue making their money, whether it's exchanges or dark pools. You clean that up, and you can make a much more efficient market where there are high-frequency traders, retail traders, institutional traders, hedge funds. Who cares? I really don't care who I'm interacting with, as long as it's a fair marketplace and it's a transparent marketplace.
Hey, Joe, quick question for you here. Doing much on the IEX. We talked to you about the book Flash Boys and everything. And, are you sending any orders there? Do you have any idea how they're doing as far as increasing volume?
Yeah, actually, we have a direct connect into IEX. So there's multiple ways to access IEX. Some brokers will just send an algorithm, and through their algorithm, they'll piece out a little piece into IEX. We've got a direct connect in where we'll sit and rest. And the best way to trade with a dark pool that's a clean dark pool, we consider IEX a very, very clean flow, is to sit and rest. And then hopefully you're basically happy you're going to attach to another order as it comes through. But in the meantime, you're trading in other spots as well. You don't just sit there and leave your order by itself. But we found that with the fills that we're getting there are fantastic. Certainly much larger than the average trade size that you see on the lit exchanges, which is like 200 shares now, or even the average trade size on a dark pool is still around 200 shares. So we're getting much more robust fills, higher quality, much less wiggle. When I say wiggle, a lot of times you'll jump into some of these dark pools, and the next thing you know, the stocks are on the move because they're sending out conditional orders. There's all sorts of noise that's going on in the dark. You don't see that on IEX. So they have built a very clean model, and it's the way it's supposed to be built. It's a real, what we consider a crossing network. Right? In the old days, we called dark pools crossing networks. That's what they used to be known as. It's where institutionals went to come in there and cross stock with as much less wiggle as you can. Nowadays, the dark pool is pretty much a ping destination. So they are kind of going about it the right way, and we're very happy with them, and we hope they succeed even more.
Do you have any notes on their overall volume? Are they increasing their volume?
They're about 1%. They seem to have capped. They came out strong. They start actually, months after Flash Boys came out, they had a huge pop. I think they've sitting about 1% market share. What they're going to be doing actually in the next couple of months, which is going to be very interesting, starting on April 1st, they're going to allow people to come in there and light their quotes up. In other words, you're going to see now in the montage an IEX quote. It's not going to be a protected quote, so it won't be an exchange at this point, but it's the first step for them becoming an exchange, which is their next level of, that's where you get to see the market share really start to ramp up. So they have a plan, which is great, because they didn't just come in there and say, okay, we're done, we got our market share, and we're happy. They've got a plan to really increase market share and to help the market, fix things like we've been talking about.
Joe, you just made a great point there, and for our traders and investors out there, by putting an order out somewhere, and I'm sure you send it out for more than a couple hundred shares of IEX, by putting out on that exchange and not getting hit, if you're trying to buy at 82 and you're not getting hit on your decent size 82 bid, then if people come in at 8205, 82010, and you want that general area, then you're buying it. You know what you want. You know what the market's doing by placing orders out there, and I think that's a very important point for traders, and investors to know. Well, we've had Joe Saluzzi on the line. He's a co-founder and partner at Themis Trading, giving us a fantastic take on high-frequency trading. I know we'd love having you on, Joe. Have a great trading day, and we'll talk to you again soon.
Dennis and Joe, thanks a lot. Take care now.
Okay.
Thanks, Joe.